Hello, this is Doug Gerlach from iClub Central. Welcome to our webinar. Today is Monday, April 10th, 2017. Glad you could join us for our Lunchtime Stock Club for April. Today we're going to take a look at a stock of interest. We're going to consider how the market's been performing year to date, what might be coming down the pipeline in the months ahead, and we'll also talk about some words of wisdom from one of the great minds of modern investing. So glad you could be here. Before we get started, let's review. If you're having technical problems at any time during our webinar, please contact gotowebinar.com directly via their toll-free number or on their website, and they can help diagnose and get you reconnected as quickly as possible. I am speaking now, so you should be able to hear me. If you can't, or if the graphics become choppy during the presentation, we recommend that you don't run any other programs on your computer, that you connect using a wired connection and not Wi-Fi if possible, and you can always listen using the telephone if the audio connection drops out. At any point, you can ask a question by typing it into the GoToWebinar application in the questions box there, and I'll be monitoring those, and we'll do my best to answer them as we go. The handout for today's presentation is also available in the Handouts tab in PDF format, so you can click and download that to your computer, print it quickly, or save it for future reference. And as always, we will provide that handout when we archive this video session after today's presentation. The complete archives of all of our iClub Central webinars are found on iClub.com in the Learning tab. That's where you can find our upcoming schedule, as well as links to the archived webinars and the downloadable handouts, which are provided in the webinar archive library there. So please visit iClub.com for all of our archived information. The Facebook page for iClub Central is just that, iClub Central. There you'll see announcements of our various webinars, as well as announcements of the video being released for viewing on demand of our webinar presentations, as well as other announcements related to our product line of tools for individual investors and investment club. Just search iClub Central on Facebook and click the like button there. So here we are, the second week of April 2017. Tax returns due in just a week and a day. For personal individual returns, the investment club returns were filed as of March 15th. So those of you in clubs should have your K1s and be ready to produce your individual returns if you haven't already. So where are we year to date with the market? There's been plenty, of course, in the political world to drive the market in all sorts of directions, but here we are looking at the three market segments that I like to track. The Russell 2000 Small Cap Index in green on the bottom, the S&P 500 in blue in the middle, and the Morgan Stanley EFA Europe, Australasia, Far East Index in magenta on the top. And the story to date, the international large cap stocks have been outperforming the domestic companies on average, with a 7.04% gain year to date for that EFA index, compared to 5.4% for the S&P 500, and now down just barely up a point to one. Actually under 1 percentage point, 0.76% return year to date for the Russell 2000. The Russell had been performing strong and has dropped off in the last couple of weeks over concerns, again, probably about the U.S. economy. The large caps remain strong. There's still demand. Yields are low, so a lot of investors who might otherwise be fleeing to safety or hanging on to their large company stocks. You can see that return is sort of flattened out in the last couple of weeks as the S&P 500 has retreated a little bit from some of its all-time highs reached in March, and is now kind of waiting to see what's going to happen, I think. That's a large part of the thesis for where the market is right now. With some of the employment and production numbers coming in under expectations, we turn to the S&P 500 PE ratio to take a check on the valuation, and that PE ratio continues to climb, as it has pretty consistently since the market bottomed out in 2010. So we're at a fairly rich PE ratio, even going back into the last 100 plus years. You can see that if we remove the outlier years of the 90s and the market crash of 2007, 2008, when the financial markets and the housing industry took a dive, and the kind of accelerated, hyper attenuated PE ratios of that period, you can see that we are at a pretty rich valuation, and we remain there. The market is not really recovered as it's reaching new highs. It's being driven by, of course, S&P 500 earnings, and you can see those earnings are actually up about 80 cents since 2 months ago, the last time we met. So corporate earnings are gaining a little bit. They had dropped off, but now they are coming back up, and that's the key driver in the long term of the market. How are companies performing? How are they performing fundamentally in terms of their profitability, in terms of their growth potential? And so you can really see that we've had a little bit of a fall off in corporate earnings. The market has remained at a high valuation, and that's how we get that higher PE ratio. But the market has a lot of expectations built in for earnings to continue to improve this year, and that's either due to or in the hopes of tax and business reform on a government level, perhaps, hopes that maybe some government policies might drive American business as opposed to helping drive the imports up or maintaining the level of imported goods in the U.S. So again, there's reason for some folks to be pointing to the current situation and saying, "Yep, this is fine. Everything's normal. We're going to have some good times ahead." And of course, there are a lot of people who are not quite so sanguine about the direction of the market, but still holding on. And as we see in all sorts of bull markets, the market continues to go up even when people expect it to go down. The market can always reach new highs. People have been predicting bear markets for the last 3 or 4 years. They have not come around. We're in a long run of economic expansion, and the market continues to move upwards. So in a lot of ways, it's counterintuitive, and we would expect, if you were just going by the numbers and the way that the market cycles have been historically, you would say we are long past due for a correction, even into a bear market, but that continues to not be the case, and we continue to see investors sticking with the stock market, buying on the dips, and not panicking when the market reaches new tops. So again, a difficult market in many ways, especially for us as growth and total return investors. It's hard to find bargains in the current market. It's tough to find companies that are in what we would consider an inexpensive valuation range, and so we continue to struggle with that more and more as this bull market continues with its very, very long run moving upward. So we'll continue to try to find quality stocks at a reasonable valuation, and we will continue to sell when the market and when companies are topping out. We'll continue to use strategies to make sure that our downside is limited, not holding on to companies that are excessively valued for too long, and thinning those positions out as best we can, and then continuing to find those companies with the highest level of quality in their fundamentals that will drive our portfolios over the long term. So that's where we stand as of April. Not a whole lot of change as the market continues to chug right along, but we need. Again, it just gets harder and harder to hear the same message over and over again. For growth stock pickers, bear markets often provide opportunities, good buying opportunities for savvy investors. And we're just not seeing a lot of a terrific amount of buying opportunities right now, but we're going to stay the course, and we're going to remain fully invested in the market. So today we're going to turn once again to one of our favorite pundits, one of the great investing minds, and this is Warren Buffett's partner in crime or partner in finance, Charlie Munger, and one of his great quotes that I like is this: a majority of life's errors are caused by forgetting what one is really trying to do. Seems very simplistic and straightforward, but when you think about it in the context of investing, you realize there's a lot of truth there, that if you look back on the times that you made investment decisions and you reconsider what you were really thinking at the time, or what you were really feeling, what was driving your emotional state, what was driving your decision-making process, you'll find that it wasn't really your overall objective of earning wealth in the market over the long term, but maybe you were trying to score a quick hit in the market. Maybe you were trying to take a gamble instead of a calculated decision about a particular company. Maybe you were driven by fear and you sold too soon because you got emotionally hooked up in it, or maybe you were overcommitted to a company because you were recalling the fond times that you had shared with that stock as you had discovered it and as it had generated a return for you, and you thought there was still more to come, and so you held on for too long. All of those can be attributed to the distractions that come that are naturally part of our thought process, that as we try to be logical and rational and try to be focused on the long-term nature of the market, with all of the noise that's generated in the near term, with all of the news and the media that's inescapable, telling us that everything we know is wrong and trying to drive us to make different decisions, it gets real easy to be distracted by the market, by the media. So we need to remember to stay on track. We need to focus on our goals. We need to remember that our objective is not to make a lot of money this year, not to make a lot of money next year, but to come out ahead in 5 years, 10 years, 20 years down the road, and to ignore the short-term volatility that comes to play. We have someone who keeps writing to the Investor Advisory Service support line and wants to know our drawdown on an annual basis. What's our return every 12 months? What's the rate of return that we earn? How much do we earn on a monthly basis? What's our rate of return? And we keep explaining that that's not the way that we look at the market, so we don't care what our annual rate of return is. We're focused on the long term, so we care how we perform over 5, 10, 15, 20 years. That's where we are looking to outrun all of the fads and short-term gyrations of the market, and allow companies that are well managed the latitude to grow their businesses over time and pull their share prices along with us, right along with them. And so we know that mindset is out there from competing interests, and people have been trained in lots of different ways to look at the market. But our approach is one that we're not going to be, we're not going to all of a sudden get out the spreadsheets and calculators and try to figure out our return relative to the overall market on an annual basis over the last 40 years. We just don't think that we're gaining anything by knowing that information. We don't think that anyone can really evaluate us based on that information as well. But when we start looking at those longer term periods, then that's where we find value in the numbers. But as Charlie points out here, if we get distracted, then we're going to make mistakes. And so I challenge you to kind of think about your investing mistakes and think how much of it came from forgetting about the real goals and objectives of your investing approach. And I certainly have had experiences there where things looked too good to be true, or where I was able to discount certain elements in a stock as I looked at the company. I ignored the warning signs and forgot the discipline. And that's when you end up getting into trouble. As Charlie points out, if investing weren't a little difficult, everybody would be rich. If it was easy, we'd all be millionaires. Because it's not easy, it's something that we have to work at on an ongoing basis. So hopefully the tools that we make at iClub Central, our newsletters and our toolkit software, and the better investing tools can help you to build wealth over the long term in a sensible fashion. And remember, we're trying to invest in the market. We're not trying to trade the market. We're not trying to take advantage of short-term trends as if that were possible on a regular basis, but to do what works over the long term. Al points out another fun book about Charlie Munger called The Tao of Charlie Munger, and that seems right up my alley. So thanks, Al. I'll take a look at that. So in terms of other books that I've been reading, I finished a book recently that was very interesting. As you know, I'm a history of the market. I like to understand what's going on, what's happened in the past. I think that if we understand the past, then we are not doomed to repeat it in the future. If we understand the causes of the market events of modern history, maybe we can avoid them in the future. And I read The Great Crash, 1929, by John Kenneth Galbraith, who was a noted economist out of Harvard, and he was active in several presidential administrations: Franklin Roosevelt, Truman, Kennedy, Lyndon Johnson, and he was also a U.S. ambassador to India under the Kennedy administration. He wrote a lot of books, including American Capitalism, one called The Affluent Society, and the New Industrial State. He was kind of unique in he was an economist whose books were bestsellers for the last half of the 20th century. His books were very popular. And so this book came about in the 1950s. So this was well after the crash of 1929. It was published in 1955. And he was arguing about the causes of the great crash of October 1929 and what happened. And his primary thesis, and this was also part of the examination of the role of the Great Depression. Some people believe that the market crash caused the depression. Others thought that the factors leading into the depression caused the market crash. So what is the relationship between them? So Galbraith argued that the 29 market crash was really precipitated by speculation, that there was so much speculation going on, the possibly apocryphal story of John D. Rockefeller selling out of the market when a shoeshine boy wanted to talk about stocks. He just thought that that was a sign that if the shoeshine boy is investing in the market, then everybody's investing. That means there are a lot of people who don't know what they're doing, and this is near hysteria. So this similar to that in the Great Crash, 1929, there was a similar outcome. But further, he talks about the causes of the Great Depression. What were really the problems that caused the Great Depression? After all, the market was up and down. The crash of 29, although it triggered a lot of activity in the economy and the market, and it's sort of seen as the start of a long period. It was really the subsequent crashes that wiped out people. That there were a lot of people who got out of the market right away when the market crashed, and then a lot of people started getting back in, and then later in the 30s, as we had subsequent corrections and crashes in the market, that's when a lot more wealth was wiped out. But the depression that then kicked off was arguably caused by 5 factors that he outlined in the book. One was an imbalance in the distribution of income across the country. and at the time, he argued that 5% of the population that had the highest income in 1929 received approximately 1/3 of all personal income in the U.S. And this is not unlike the recent Occupy Wall Street, the 1% versus the 99%. How much wealth does the 1% actually own? Well, in 1929, 5% of the population received 1/3 of the personal income. And so this disparity in the distribution of income really left the economy dependent on a high level of investment and as well as luxury consumer spending. The second problem was problems in the structure of corporations. There were holding companies, investment trusts that were formed, and he talks about, in particular, one formed by Goldman Sachs that lost, that sold as high, this trust sold as high as $200 a share. In the aftermath, it was $1.36 a share. And again, it was an example of Wall Street creating entities that were based on using lots of leverage, based on trying to benefit from the speculative bubble that had emerged. And so those entities that were pumping money into the market were doomed to failure when the market went south. The third was the bad banking structure. There was a large number of banks that were working independently, but there was a domino effect that certainly came into effect as unemployment and income rose and incomes fell. And of course, in the aftermath of the Depression, there were a lot of banking and investment banking reforms that were put into place. FDIC insurance became popular. We had a division between investment banking and commercial banking that was put into place. Some of those repeals have been listed in recent years. So some people would point to those as examples of why policy has not been made in the interest of individuals over the last decade when it comes to banking policies. And certainly this is one of the causes that was pointed out in this book. The fourth is foreign trade imbalances. During World War I, we actually became a creditor nation for the first time, exporting more than we imported, and that meant that we we owed a lot of money to entities outside the U.S. government, U.S. Itself, to foreign governments, for instance. And so when those foreign governments started to fall, exports fell, and that was really hard on farmers in particular in the U.S. And finally, the fifth cause was poor economic intelligence. And even as an economist, Galbraith was not averse to pointing to the failures of other economists in their thinking, in their misunderstanding of what was going on. And so he was really even took to task his colleagues at Harvard University, which was one of the leading, and remains one of the leading hotbeds of economic intelligence in the U.S. and in the world. So I like to think about these 5 causes here, and to think about how much of them are really still at play today, and how close we could be to a Great Depression. Certainly, the Great Recession of 2007, 8, 9 was touted as possibly the second Great Depression, but for a number of reasons, and never really manifested. And a lot of the speculative nature of the market, at least in the stock market side, has been mitigated by limitations on the use of leverage by individual investors. Now, hedge funds can do whatever they want with affluent individuals, and we've seen hedge funds that have exploded. In the housing market, though, we also see the aftermath of a speculative bubble, where people were buying homes, buying properties they couldn't afford because there were low interest rates, there was lots of capital available, but the financial markets recovered pretty quickly, and the housing markets have certainly recovered since that point as well. So I think this is an interesting book. It's not a very long book, certainly something that you could read very quickly. You have to kind of keep it in perspective. This book was written 60, 70 years ago about an event that happened 90 years ago. So Galbraith did have the advantage of hindsight in looking back and really trying to understand what was going on with the market. So just a book I picked up, and interesting if you really want to understand more about the Depression and the market crash of '29. Ultimately, again, there are some shockers that you'll discover, and there are some myths that are debunked. The myth that stockbrokers and investors were jumping out of buildings in Manhattan just really never happened. There were a few high-profile suicides, but by and large, people were not jumping out of windows. They were certainly affected, and fortunes were lost, and people who had been comfortable had saw their savings go up in smoke. But there was not the wholesale suicide trend that has been characteristic of the Great Depression and the stock market crash of '29. So that was interesting as well, to be able to look at the numbers and the statistics to disprove that common belief, and that common belief persists today. So just because something is disproven doesn't mean that people stop believing it, unfortunately, as we all are well aware in the current political environment, I would suppose. All right, so let's take a look at a stock to study. And this is a small company stock, profiled recently in our small cap Informer. I see this as a little bit contrarian, but there's a lot of good things to like about this particular company. So I certainly think they've got the track record, and there's plenty of opportunity for growth in their market no matter what happens. The company is Essent Group, trades on the New York Stock Exchange under the ticker ESNT. They are a provider of PMI, private mortgage insurance, which is offered to homeowners and to their often required by lenders to protect them from the failure of someone who is no longer able to pay their mortgage. So private mortgage insurance will help mitigate that credit risk, and that means that lenders aren't on the hook for the failures of their the mortgages that they make, the mortgage loans that they make. Often, as you probably are aware, PMI is required for at least for a certain amount of the loan that you have outstanding, or you don't have a big down payment. You'll be required by your lender to pay PMI. Essent is licensed to make PMI loan insurance policies in all 50 states and the District of Columbia, and they're also approved by Fannie Mae and Freddie Mac. So they're one of the few companies that does this primarily as a publicly traded business. They also have a subsidiary in Bermuda that offers reinsurance as well as advisory services and other mortgage-related insurance from the base in Bermuda. So the company began writing mortgage policies in 2010, and they have 12% of the market. There are 7 major players in the mortgage insurance industry, and Essent is the 5th largest by market share. So that means they're a small player in a bigger market. 3 of its direct competitors are publicly traded: MGIC Investment, Genworth Financial, and MMI Holdings. So you can look at those 3 other companies and do some interesting comparisons. Some of those businesses have broader business operations, and so they're actually not categorized in the same industry group as Essent, which Morningstar calls a specialty finance industry in the financial services group. But it really goes to show when you look at the profitability of Essent compared to these other businesses, they are really chugging along nicely. As I said, they have about a 12% market share of the PMI total market, which is a market that is growing. First quarter of 2015, the market was $44 billion. First quarter of 2016, the market's $45.3 billion. Essent maintained its 12% share over that time, which means it gained in revenue because the market expanded. But you can also see the larger chunks in this market on the right, the United Guarantee, MGIC, and Radiant, all contracting, while the smaller players, the yellow arch and 9%, the green for National, and Essent in red, and Genworth in orange, all were stable or expanding. So those smaller competitors are really taking market share. So in a growing market, they're helping to take market share. And when you look at the stock selection guide, you can see this is what draws us to this company. Began in 2010, went public in 2013. So you can see we have became profitable in 2013. They may have been marginally profitable in 2012, but we're going to focus on the 2013 plus year, where sales have been growing 50% a year, reaching $458 million last year. Earnings have been growing at 52% a year, so chugging right along, and pre-tax profit has been growing as well. On this graph, you can see the projections for sales and earnings growth over the next few years by Wall Street. So Wall Street is a little more aggressive than our expectation of 16% growth. So we're really looking for the company to grow on average about 16% a year over the next 5 years. Of course, when we're looking at a company like this, what could slow them down? Well, obviously, rising interest rates could cause fewer people to buy new homes, although, yes, interest rates are going up, but we're talking about a quarter point, half point at a time, and so the cumulative impact over the course of many years may see numbers of people not buying homes or holding off a little bit longer, but just because the Fed raises interest rates a quarter point is not going to take a significant dent out of people who are shopping for new homes. So there's still, I think, opportunity there. Home sales, what's going on with home sales? There's some indications that home sales have peaked a little bit, although we certainly have been following in the small cap informer some home building companies that have been performing really well and are continuing to drive the market forward, not simply by buying homes, but by being a little smarter about energy efficiency, solar panels, communities that are well designed, that cater to the modern needs of homeowners. So I think there are a lot of trends that are holding strong for the home building segment, and so I think that's going to help Essent. Now, we may see some contraction at some point, but I think our 16% growth rate is pretty conservative, all things considered. The Wall Street analysts are looking for a consensus 17.35% annual earnings growth. And over the next couple of quarters, analysts are looking at 20% growth. So we think that this company has got a lot of potential ahead as it continues to take market share and continues to benefit from the expanding market of its industry. I'll flip over to Toolkit now, and we'll flip over to the back so we can look at the profit margins, which have been really performing well, and so there's plenty of opportunity again for the company to continue to grow profit margins. You can see upwards of 65%. So there's plenty of room there for the company to continue to plow forward, even if they don't expand those margins. just maintaining them, or even if they drop off a little bit, they've still got plenty of room to maintain their profitability. And so that seems to be from a position of strength. I think when you look at the competitors, that's when you can really kind of see some of the advantages of Essent compared to some of these companies. So let me show you. I'm going to show you in just a second here some of the peers so that we can compare them. I'm going to flip over to our equity research service website, and okay. So here we are at ERS.com, and I've plotted in the three competitors that I mentioned: Genworth Financial, which is GNW, MGIC Investment, and MTG, and NMI Holdings, NMIH. So those are the key competitors for Essent in the publicly traded space. So you can see their profit margins, Essent here in blue, so much higher. MTG is number 2, and then way down below we see GNW and NMIH, now bigger companies that have other business lines, so we're not focusing on the PMI market exclusively. Return on equity, again, kind of all over the place, but you can see Essence here, average of 21.24, which is pretty extraordinary. Long-term debt to equity, if we limit the scale, you can see here is Essence debt. Long-term debt to equity, 7.7%, much lower than their competition. And the total level of their long-term debt is about 100 million, so very limited there. Long-term debt to capital, same story over here. Long-term debt to capital, you can see Essent is way below, so much less debt financing, which might help return on investment capital. Their trend has been going up the last couple of years, so you can see here in 2016, much higher than everyone else. So when I like these comparisons, I think that they certainly position this company as a leader in terms of fundamentals, and so that really kind of clinched it for me. The growth is there, fundamentals are there, and we can argue and discuss industry trends. This is the right time to be in this particular industry group, but I think buying a good company is certainly a good decision to make in any market or cycle. When we talk about debt as well, Essence debt is rated lower medium investment grade, so it is investment grade. It probably will go up as the company matures, but because the company is so young, it's hard for the credit rating agencies to give them a much higher rating. But so far, it seems like they're performing well. Good cash flow growth, supporting earnings growth, good capital position. So when we look at the PE ratio, I'm going to go ahead and update the price. It was $35 2 weeks ago, and it's $36 now. Well, that's good for us. When we presented it, it was 35. Now it's 36.61. But the PE ratio is 15. Again, for specialty finance companies, that may be a little rich, but you can see it's in the range of where the PE has been. On the high side, it's a little below that. So we're using a selected high PE of 15.7. It's been as high as 15.8 in the last 52 weeks. If we look right here at the 52-week high PE ratio of 15.8. So we're projecting a slightly lower high PE, based on the average here, 15.7, which gets us to $79.40. So from $36, it's a little less than a doubling from this point. At 35, it's certainly a little more attractive. I'm sorry, it is a little more. We're still in the range of getting your desired total return. Yeah, 36. That'll give us $73, and the high price of 79 is a little more than that. So right here, it's just at a 3-to-1 upside downside ratio based on the current price, and total return of 16.7%. So, I would say this is one you might buy in the dips, but you might think about taking a position now, doing a little research, and trying to understand the company and following along as it continues to progress. The last couple of weeks have been a little choppy for the market, so it's good to see the company has gotten its has seen its price rise just a little bit. No dividends, so nothing there. But I think an interesting, certainly interesting small company stock that is worth taking a look at. Limited PE ratio history, going back to 2013, you can see the high levels of PEs after the company went public in 2013, and then have drifted down. But I think in the last 52 weeks, it's been between a range of 8 and 15.8. So could be some volatility there, as we expect from smaller companies. But in the long term, fundamentals certainly appear to be in place, so you might take it down. All right, so let's see if you have any other questions. Walter says that AAOI, Applied Optoelectronics, is down more than 20% recently. Is this just profit taking? Yeah, I believe that it is. AAOI is a company that we have been tracking in our small cap informer. It's been performing really well. It actually went up. Gosh, it went up. It's such a great great level of return. I think it's tripled since we started covering it, so it's performed really well. And I think in the last couple of weeks, it's just taken a little bit. If we let's look at the 1 month here. So you can see it really hit a high up here at 40, and it's drifted down. The fundamentals have been strong. The last time the earnings came in, companies seem to be doing well. So yeah, I think the fundamentals are still pretty strong. You can see here this little graph of the actual and estimated earnings on Yahoo. So the blue circles are the estimated, and the gold circles are the actual earnings. And you can see they've just been consistently outperforming the market or expectations with their quarterly earning results. And so I think I think there's just some profit taking going on, and maybe it's a good opportunity to take a look at the company if you haven't already. Interesting business. I think the fundamentals are pretty strong. It is and this is a small company in technology, and so it's definitely going to have some volatility to it. You can see over here they make fiber optic networking products for internet data centers, fiber to the home networking and modules, etc., lasers, equipment like that. So there's a lot of growth in this particular market, but it tends to go in boom and bust cycles. So Mark wants to know about Manhattan Associates, again, which is another company that we track in the small cap informer. I'm not the I don't cover that one especially. It's down a little bit in price in the last month, in the last 6 months. And I can't remember when we initially started covering Manhattan Associates. Let me take a look here real quick. We're still covering it, though. We didn't discontinue it. We started covering it in October, so it hasn't been that long. It was $50 when we started covering it, and it's roughly $50 today, right? It's 50, yeah, 49. So it's the same price that it was in October. Hasn't really seen a whole lot of change so far. We're looking at 15% earnings growth. Haven't changed that. At buy up to $52. And if you can do that, we think that 15% growth rate is pretty achievable and reasonable. So it could be one that you might take a look at. We can take a look at it in Toolkit. So you can see what what caused us to be interested in this company. There you can see the earnings, sales, and profit growth growing. The high price, you'll notice in 2015 kind of topped out and then it's retracted a little bit. I think that's just normal case of the price getting a little bit ahead of earnings, and the company and then just waiting for earnings to kind of catch up a little bit. This company provides software for warehouse management. They're located in California today, and that's just really important in the current kind of just-in-time delivery systems that businesses want to see. So the software that Manhattan Associates provides helps to simplify these complex services the companies require to get and manage products in their supply chain, to manage their inventory, to do forecasting. They supply into the retail, food, and grocery markets, consumer goods, logistics service providers like shippers, life sciences, industrial and wholesale companies, high technology, electronic transportation providers, and the government. So their software is used all over the place, which is pretty good. U.S. accounts for about 75% of revenue. So this business, again, we think this is the kind of company that does well because they help companies to make smarter decisions. They invest in this software. It allows them to be lean and efficient. And you look at the margins. Again, no surprise why we are drawn to this particular business. They have just continue to become increasingly profitable, and so that's gonna happen. Last time we looked, the price was $49.54, and I think it's, as we just looked at that same price, now it's $48 today. So it's still in the buy range. It's come down. It hasn't really done anything for a couple of months, but earnings have been positive. If we flip back to the front, in the fourth quarter, earnings were up 16.7%. Sales only up 4%, 4.4% during the period, but they really have been efficient. So that seems to be a good sign there. I'm going to take a look at some of the other questions here. Michelle asks about NIC, ticker eGov. This is a major company that a major provider of portal software for local and state and federal governments, as well as, so this is software that you in many cases, when you want to renew your driver's license, you can go online and fill out a form to make it happen, or to pay property taxes, you'll go online, type in the number from your bill, pay the taxes online. So those are the sorts of things that NIC provides under contract for government. So they install the system. You can see good growth, fairly consistent. The problem with the business is their customers are the government. And really, on the one hand, I feel bad for anyone whose business is exclusively focused on local, state, and federal governments, because it's always a battle of the budget. It's always a battle of all sorts of regulations that you have to navigate. But this is NIC's business, so they're pretty good at it. They do this on a regular basis, so they know how to navigate. They know how to win the contracts and service the contracts and get the renewals. But in many cases, their revenue comes from sort of a percentage of the revenue that comes into the portals that they program and operate for the various states. So the end result is that you end up with contracts expiring, and then new contracts coming on board and ramping up, and so the resulting earnings tend to be a little choppy, I think. But investors tend to stay the course. You can see kind of a narrow range of prices over time, and the current price, is up from where it was in 2015. It's the midpoint of where it was last year. So if you're a recent investor, it might not be as attractive. Again, it's a company that I think you wait for the opportunity to buy it when it's at the low end of its valuation range, and then hold on over the long term. But again, we haven't seen anything that's making us say that things are different or that things are going to change. Although, in fact, if we see a lot of changes in government spending, it's conceivable that could have an impact. But most of the projects that they provide generate income for the government, right? So people are paying their taxes. People want to do this stuff online. They want to be able to get it taken care of and not have to, fill out paper forms or make a visit to an office to pay their bills. So it's something that consumers want and expect. So we think that's going to help NIC's business over the long term. Al asked about Skyworks, who provides Apple. Skyworks we've followed for a long time. It's been a good performer for our small cap informer. We recommended it in November 2013. It was at $27 then. It's currently at $97, $98. We recommended it again in October of 2015 when it was $79. So it's up $20 since then. They are a chip provider. They provide a whole lot of different kind of chips and analog and processing for phones and mobile devices. They are a supplier for Apple. So when Apple makes announcements about their expectations or their performance, Skyworks is one of the companies that gets hit or goes up. But they have consistently been increasing the percentage of their chips in their, that's not it, wrong company, their chips that are in their customers' products. So they're kind of gaining market share. At $3.2 billion, they're a little bit big for our small cap informer, but they performed, that's because they performed in 3 years. 3 years plus, they've performed really well and really grown their business. You can see the last quarter of last year was a little flat for them. And again, this is a choppy business, the semiconductor business. But I think over the long term, again, I don't get too worked up in either direction when people talk about Skyworks relative to Apple, that Apple is seeing, sales of this product go down, and so that's going to hurt all their suppliers. And then somebody says, oh, but this supplier is going to provide more chips for them, for their products, more components, so they're going to actually see a gain. And it gets really hard, and Apple kind of plays it close to the vest. And so it can be hard to evaluate all those different rumors. And so we try to maintain our long-term focus with Skyworks. I think it's a very well-run, efficient technology company. The semiconductor industry is notoriously volatile and fickle, but they appear to be investing well in R&D and developing new products that have made them perform pretty well. So if we look at Skyworks, there's the graph there of Skyworks. So you can take, again, you can see. But you can see there's a little bit of volatility of earnings and sales growth. It tends to go up, it tends to go down. It's not the most consistent company. And this is a dynamic, moving industry that they're serving in the technology sector. So we kind of expect that. And we've ratcheted down. I've ratcheted down the growth rate expectation to 14%. I think they're going to do much better than that. But that's just out of an abundance of caution. It's take into account some of that volatility that I expect. I expect to see a quarter like this where it's essentially flat, or where you can see trailing 12-month earnings have fallen in the fourth quarter, or the first quarter ending December 31st. So again, but I'm not going to get over excited about it. Certainly, when you have gains in a company like this, you want to be a little more aggressive about protecting those gains, about selling when they reach the high end of its valuation range. You can see the P ratios are kind of all over the map. 2013, when we were buying at a low PE in the 13 to 18 range. The PE shot up to 20, as high as 27 last year, and has come back down a little bit. Now it's back up to 20, just about 20. So we're just going to expect that kind of volatility. And when you see the PE ratios get way out of whack, it's time maybe to take some of your investment off the table. But as I pointed out, they still continue to perform well, and in 4 years they've just about quadrupled in price. So it's been a good investment for us, and one of the top performers all in all. And I don't expect that to change anytime soon. Okay, one more stock here. Bruce asked about BJ's Restaurants. BJ's is a chain of based around a brewery. The ticker is BJRI. Brewery, but they operate restaurants. They operate restaurant brew houses where they actually brew in the restaurant, and they have a brewery facility. And they're kind of experimenting with that. So beer is a focus, and this is fueled by the interest in craft beer. So people are interested in locally brewed beer, but BJ's also caters to the craft beer connoisseur, so they've got a large selection of beers on tap, and they also have generally a very family-friendly atmosphere. So this is we're not talking about bars so much as restaurants, where you can bring the whole family, you can have a good dinner. You can see here sales growth has been pretty strong. Earnings growth a little less consistent as we battle economic trends and some other headwinds the company's been facing. In the fourth quarter, earnings were up almost 28% on a 14% sales growth. That's pretty strong. The company's warned that the growth may be coming down a little bit, and this year may be sort of a restructuring year of sorts. Largely it has to do with, again, changing tastes of consumers and the vicissitudes of the restaurant industry. They have an expansion plan in place. They're not truly national, but they're investing in opening new restaurants along some of the eastern interstates. And they like these interstate corridors as just a way to reach a maximum audience. When we first looked at BJ's, besides the craft beer component, one of the impressive things about the business is that they have one of the highest revenue figures per square feet in their segment of the restaurant industry. However, their average cost per check is lower than many of their other competitors. So what that means is they fit more people comfortably into their floor plans, and they're constantly tweaking that to see, can we get a few more people in, and how we arrange the tables without making people feel like they're being shoehorned into a space, and then deliver a dining experience that people feel like they're getting good value for the money. So those are very hard things to do. And so when we look at some of the competitors, a competitor like the Cheesecake Factory has a much higher average check price, and that's at the high end of the casual dining sector. People go to the Cheesecake Factory. It's a little more premium experience. And there are a whole other array of restaurants in that casual dining space, but BJ's is a place where you can go on a regular basis. You feel like you're getting a good deal. They have a rewards club. They have a special dessert, the pizzuki, that is phenomenally popular for some reason. So I think the prospects are good. I think this is going to be a little bit of a rebuilding year for the company. If we look at the back, and look at the, so it was $38 last month, and now it's $40. So, you know, the minute you start to say it's going to be a rocky time and the company's rebuilding a little bit, the share price goes up. So I still see it as a buy up to $44 roughly. So I think there's an opportunity to get a decent return by investing in it. The current PE just 21. That's much lower than it's been in the past. I consider all of the PEs of the last 5 years to be outliers because the company is slowing its growth a little bit, but I still think it's in that 15-16% range is doable over the longer term. So to justify a high PE of 25, I don't think is out of the question there. So I'm still bullish on BJ's. I know they've had a little bit of a a slowdown and sort of warning in the growth. The company was $43 when we started covering it last June. So at $40, they're down a little bit, but I'm still sticking with my 15% growth expectation, and that buy price of around 44, 45, I think is a reasonable price to get into a company like this. When it's $38, even more attractive, but $40 I think is still a pretty good opportunity ahead. Again, just knowing that perhaps this year, the next couple of quarters, we're going to learn a lot more about how they are doing on some of the metrics that we're watching. All right, well then, we will wrap it up now. A reminder, this month I'll be in Cleveland for the Northeast Ohio chapter of Better Investing. I'll be doing a half-day workshop for them on April 22nd. Then I'll be back in Ohio on May from the 19th to the 21st at the Better Investing National Conference. And if you are an investor advisory service or small cap informer subscriber, we've got something special planned for you for that event, so stay tuned. And then in June, I'll be in the Washington, D.C. area for a joint presentation to the AAII and Better Investing chapters there. We'll be talking about our award-winning approach to investing in the stock market. So hopefully I'll see you at maybe one of these events. We've got more planned throughout the rest of the year. I'll be back in Orlando at the AAII conference in November. I'll be in Portland, Oregon. I'll be in Indianapolis. I'll be in Seattle this year. So I've got a full schedule of events, as always, planned for the summer, fall, and into the winter of the year. And we'll also see you at next month's Lunchtime Stock Club webinar. Do check the schedule with my travel schedule. Some of the events, some of these Monday sessions get canceled, but we will try to, and so we do list those on iClub.com. And there was some problem last year, I know, with or last month with the webinar that was canceled, and there was a glitch that at the GoToWebinar site that it didn't get canceled properly. So we're going to make sure that doesn't happen again, and I apologize for that. We'll look forward to seeing you next month. I hope the spring is treating you well, and thanks once again for joining us at our Lunchtime Stock Club.